As we've been reporting, earnings reports for Exxon Mobil and Chevron show a decrease in profits during the last fiscal quarter due to financial hedges that got disrupted by the war with Iran. But despite the losses on paper, both U.S. oil giants topped Wall Street expectations when it came to revenue for the 3-month period ending March 31st. CBS News business contributor Javier David joins us now. He's also a business editor at the Dallas Morning News. So let's go further into what these earnings mean. If major oil companies aren't profiting off of these increased prices, who is? Where's the money going?
Well, look, you've got this results. They were kind of messy because the current quarter started in January 1st. They don't fully capture the spike in crude prices that from the Iran war that began late February. The full impact isn't necessarily yet reflected in their books. And as you mentioned, they had these sort of trading positions that went against them. But they are the undoubtedly immediate beneficiaries when crude spikes. Even though they have no control over the market or geopolitical forces, they'll reap those rewards later on. But there is a sweet spot in prices that allows them to fund operations, but they're sensitive to criticisms whenever oil spikes, especially and creates this impression that they're rolling in the dough, especially because of all of these events that are far outside of their control.
What does that mean they're sensitive to that?
Well, they know that it's political, that oil prices and energy prices are spiking, consumers are hurting, so they don't want to feel as if somehow they're reaping in all of this money, or they're sort of sitting in a room deciding, hey, we're going to count our millions or billions, when in fact the consumer is hurting. So that's a very sensitive thing for them. It's why the president is sort of proactively reaching out to them and trying to get them or lean on them to sort of keep prices at a specific minimum.
The president has called for oil companies to increase drilling and production here in the U.S., but isn't the U.S. already the largest producer? And we're still seeing high gas prices. So wouldn't increasing production here not really make a dent?
Yeah, I mean, a couple good things to keep in mind. Refiners still use international crude to process domestic gas supplies. So they're at the mercy of global forces like everyone else is. And I think Kelly was mentioned in the prior segment, most oil and gas companies think for the long term. So just because crude prices are high today for very specific reasons, it doesn't mean that they're going to stay that way. So they don't want to commit to ratcheting up production to create more supply that could come back to bite them later on when prices come down to earth. So, as consumers, we're all clamoring for lower energy prices. But if oil companies commit billions in capital expenditures to ramp up production, they risk creating overcapacity and too much supply. So when oil prices come back to earth, based on all of these short-term factors that we're talking about every day, they get stuck with oil they can't necessarily sell at a price that makes it too costly for them.
Javier David, thank you.